Economists are predicting further rises to US interest rates as the nation deals with near record inflation. Some lawmakers are concerned the Federal Reserve isn't doing enough to prevent a recession.
Stocks fell once again Thursday as central banks throughout the world, from Norway to South Africa, raised interest rates. The flurry of global activity comes a day after the Federal Reserve's latest aggressive rate hike, with Federal Reserve Chair Jerome Powell not backing down from his bluntest economic message yet.
And a soft landing would be very challenging.
The Fed projects the U.S. economy will barely expand this year at a 0.2% pace. Estimates were marked down to 1.2% in 2023 and 1.7% in 2024. Still, Powell insists slow growth is the price to pay.
Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability.
Unemployment could also tick up 4.4% by the end of next year, up from the current rate of 3.7%. Senator Elizabeth Warren, one of Powell's biggest critics, says that's a loss of about 1 million jobs.
My concern here is that the Fed just has one tool in its toolbox, and it's the interest rate tool.
J.P. Morgan CEO Jamie Dimon is warning of another danger.
Stagflation is the most damaging to every part of society, every industry, all income levels. And therefore, I think it's important to get our hands around inflation as quickly as possible.
And the recession fears could get worse. The Fed expects hiking rates as high as 4.6% before ending the fight against soaring inflation.